In 1990, if you bought a house for $150,000, your annual property tax bill was about $1,200. That same house today is worth $400,000, and the property tax bill is over $6,000 per year. That's 5 times higher. And here's something interesting that surprises a lot of people. Even if you pay off your mortgage completely and own your house outright, you still owe property taxes every single year. No mortgage payment, but the tax bill continues. Today, I'm going to walk you through exactly why property taxes have increased so much, where that money actually goes, and how this affects homeowners at different stages of life. The numbers tell a fascinating story about how housing costs evolved over the past 35 years. Let's start by looking at what homeownership actually cost in 1990. In 1990, the median home price in America was about $123,000. For our example, let's look at someone who bought a house for $150,000 in a typical suburb. The average property tax rate in 1990 was about 0.8% of the home's assessed value. On a $150,000 house, that came out to roughly $1,200 per year, or $100 per month. Most homeowners included this in their monthly mortgage payment through an escrow account. Now let's fast forward to today. That same house, assuming it's been maintained normally and is in a similar neighborhood, is now valued somewhere between $350,000 and $450,000, depending on the local market. Using $400,000 as our example, and with the current national average property tax rate of about 1.1%, the annual bill is around $4,400. But in states like Texas, New Jersey, or Illinois, where rates are closer to 1.5%, that bill reaches $6,000 per year. Let's put that in perspective. If we adjust that 1990 tax bill of $1,200 for normal inflation, it should be about $2,700 today. But actual property taxes are often double that amount. So clearly something beyond just standard inflation is happening here. This gap is particularly significant for people who bought their homes decades ago and have since paid off their mortgages. They expected that once the mortgage was paid, their major housing expense would end. But the property tax continues, and in many cases has grown substantially over the years.
So, what explains this tripling of property taxes? There are several interconnected factors that contributed to this change. Factor number 1. Housing values grew faster than general inflation. The most straightforward piece is that housing prices increased significantly faster than overall inflation. From 1990 to 2025, general inflation increased prices by about 180%, but housing prices increased by about 240 to 300% in many markets. Since property taxes are calculated as a percentage of the home's assessed value, when home values rise, tax bills rise proportionately, even if the tax rate itself doesn't change. A 1% tax on a $150,000 house is $1,200. That same 1% on a $400,000 house is $4,000. Factor number 2. Local government funding structure. Property taxes primarily fund local services like schools, police and fire departments, road maintenance, libraries, and parks. Unlike federal or state governments that have multiple revenue sources, local governments rely heavily on property taxes, sometimes for 70 to 80% of their operating budget. As costs for these services increased over time, salary obligations, pension commitments, healthcare costs for employees, building maintenance, technology upgrades, the revenue needs grew accordingly. Property taxes are one of the few funding mechanisms local governments have to meet these growing costs. There's an interesting dynamic here. When property values rise, local government revenue increases automatically without needing to change the tax rate. This automatic revenue growth allowed budgets to expand during periods of rising home values. But it also meant that when those higher budgets became the baseline, maintaining them required keeping property taxes at the elevated levels. Factor number 3, the property reassessment process.
Most counties reassess property values periodically, typically every 1 to 5 years, depending on the state. The goal is to keep assessed values reasonably close to market values. When the real estate market is appreciating, reassessments tend to increase property values, which increases tax bills. During the 2008 housing crisis, when home values dropped significantly in many areas, the reassessment process became more complex. Some jurisdictions were slow to lower assessments to match the new market reality, partly because the local governments still needed the revenue to fund existing commitments. Homeowners could appeal their assessments, but this required initiative, documentation, and sometimes professional help. Conversely, when values are rising, reassessments tend to capture those increases more quickly. This creates an asymmetry where tax bills rise readily but don't decrease as easily. Factor number 4, school funding shifts. A significant portion of property taxes, often 50 to 60%, goes to local public schools. Over the past few decades, there's been a shift in how schools are funded. State and federal contributions to education decreased as a percentage of total school funding, which placed more of the burden on local property taxes. This means that school budget needs, teacher salaries, special education programs, building maintenance, technology investments, increasingly needed to be covered by property tax revenue. As schools competed to offer better programs and facilities, particularly in suburban areas, property taxes rose to fund these improvements. This creates an interesting situation. School quality often correlates with property values. Good schools attract families, which increases home prices, which increases property values, which increases tax revenue, which can fund better schools. It's a self-reinforcing cycle, but it also means property taxes in these areas tend to be substantially higher. The impact of these increased property taxes varies significantly depending on a homeowner's situation. For recent home buyers, when you're looking at whether you can afford a house, the mortgage payment is the most visible cost, but property taxes add a substantial amount to the total monthly housing cost. In some areas, property taxes can add $500 to $1,000 or more on top of the mortgage payment. This affects affordability calculations. A house that seems within reach based on the mortgage might become unaffordable when you factor in the full tax bill. This is particularly true in states with higher property tax rates. For long-term homeowners, people who've owned their homes for 20 or 30 years have seen their property tax bills grow substantially over that time. Someone who bought a house in 1990 for $1,200 in annual taxes might now be paying $5,000 or $6,000. If their income has grown over those years, this might be manageable, but the tax bill grows regardless of whether their income does. The tax is based on the home's value, not on the owner's ability to pay. For retirees on fixed incomes, this is where the impact can be most significant. Consider someone who bought a house in their 30s, paid off the mortgage by their 60s, and planned to live in the house through retirement on Social Security and savings. In 1990, their property tax bill might have been $1,200 on their fully paid off house. By 2025, that bill has grown to $6,000 or more. If they're living on $30,000 or $40,000 per year in retirement income, $6,000 in property taxes represents 15 to 20% of their total income. They own the house outright with no mortgage, but the ongoing tax obligation creates financial pressure. Some states offer property tax relief programs for seniors, such as freezes or exemptions, but these vary widely and often have income restrictions. An important note about non-payment. There's a legal reality that surprises some people. If property taxes aren't paid, the local government can place a lien on the property and eventually foreclose to recover the unpaid taxes. This is true even if there's no mortgage. The property tax is a legal obligation attached to the property itself. This isn't common, and there usually are payment plans and assistance programs available before it reaches that point. But it illustrates that property ownership comes with ongoing financial obligations beyond the purchase price and mortgage.
Understanding where property tax money is spent helps explain why the amounts have grown. Education funding. As mentioned, 50 to 60% of property taxes typically fund local schools. This covers teacher and staff salaries, building operations and maintenance, transportation, textbooks and materials, technology, special education services, and extracurricular programs. School costs have increased for several reasons. Teacher salaries have grown, though not always keeping pace with cost of living. Special education mandates require additional staffing and resources. Technology needs have expanded dramatically. Building maintenance and utilities cost more, and pension and healthcare obligations for school employees have grown. Municipal services. The remaining property tax revenue funds police and fire departments, road and infrastructure maintenance, parks and recreation, libraries, local government administration, and public works. These costs have also increased over time. Public safety equipment and technology are more expensive. Infrastructure ages and requires more maintenance. Employee benefits and pension obligations have grown, and insurance and liability costs have increased. The pension factor. One significant cost driver that's less visible is pension obligations for government employees. Many states and municipalities have pension systems that were underfunded for years. Current property taxes are now being used not just for current services, but also to fulfill pension promises made years or decades ago. This isn't universal, and some areas manage their pension obligations more carefully than others. But in areas where pensions are significantly underfunded, property taxes need to be higher to cover both current costs and past obligations. Property taxes vary dramatically depending on where you live, which tells us something about how this system works. State-by-state differences. Some states have high property taxes, but low or no income tax. Texas, for example, has no state income tax, but property taxes averaging around 1.6%. The state funds itself through property and sales taxes instead of income taxes. Other states have lower property tax rates, but higher income taxes. This represents different policy choices about how to fund government services. Within state variation. Even within the same state, property taxes can vary significantly between towns and counties. Wealthier suburbs often have higher property taxes, but also better funded schools and services. Urban areas might have different tax structures. Rural areas might have lower taxes, but fewer services. These differences reflect local budget decisions, the property tax base available, and the level of services residents want and can afford. If you're concerned about property taxes, there are a few things worth knowing about. First, you can appeal your property assessment if you believe it's inaccurate. Look at comparable properties in your area and their assessed values. If yours seems disproportionately high, you can file an appeal with documentation. The process varies by location, but it's available in most jurisdictions. Second, check whether you qualify for any exemptions. Many states offer homestead exemptions that reduce taxable value, senior exemptions for people over a certain age, veteran exemptions, or disability exemptions. These aren't always automatic. You often need to apply. Third, attending local budget meetings can give you insight into how tax money is being allocated and where future increases might come from. These meetings are public and open to resident input. Property taxes have tripled since 1990 due to a combination of factors: housing values growing faster than general inflation, increasing costs for local services, shifts in how schools are funded, and long-term obligations like pensions. What was $1,200 per year in 1990 is now $6,000 or more in many areas. This affects different people in different ways. Recent buyers face higher total housing costs. Long-term owners see their tax bills grow over decades. Retirees on fixed incomes feel the pressure most acutely since the tax continues even after the mortgage is paid off. Understanding how property taxes work and why they've increased helps make sense of the true cost of homeownership today compared to previous generations. If you found this breakdown helpful, share it with someone considering buying a home
or wondering about their property tax bill. Leave a comment with what property taxes look like where you live, and subscribe for more videos explaining how costs have evolved over time. I'll see you in the next one.